Sound check. Hello, everyone, and thank you so much for joining for another session of the Retail Traders Special. We are here to talk about swing trading psychology today. So, when it comes to behavioral finance, I think the applications to the world of trading is very, very relevant And that is the reason why in today's session we are here to talk specifically about swing trading and the psychology that is required to do it. Why? Because the emotional challenges that come with trading in the market, they need to be tackled systematically. So in order to do that, I am going to discuss with you four different psychological biases which are very commonly observed among people, and I will also tell you how to combat them. Okay, first we will talk about these biases basic definition, and then we will talk about why these biases happen and what can you do to combat them, right? All right, so let me share my screen. The first bias that we're talking about is the anchoring bias. The reason why I've opened it on Google is because these biases are very well defined, very well covered, and just understanding them, being aware about these biases can really help you in understanding your own weaknesses and dealing with them in a better way. So, what is the anchoring bias? As you can see on the screen, the anchoring bias describes people tendencies to rely too heavily on the first piece of information they received on a topic. For instance, suppose you heard about the stock of Adani from the mouth of an analyst on a TV, or you read, like the first time you entered the stock market, you read in some article that Adani stock return gave a certain percentage of return to its investors in a very small amount of time. Now, what happens is that if you are not self aware or if you are not vigilant, then this piece of information gets anchored in your brain, which means every time you hear Adani, you go back to big returns for investors in small amount of time or small period of time. This is the anchoring bias, which means that one piece of information anchors your thought process very strongly. So, what happens when the anchoring bias gets you? Number one, you don't know that you've been gotten by the anchoring bias. As a result, irrespective of how the market is changing or how a stock price is performing, you keep on investing money in it or you stay invested in it. You refuse to change your opinion of the stock. I have seen this kind of anchoring bias a lot of times in stocks like Unitech, because there was a point of time when the stock performed really well, but now it has come down really, performing really badly. Usually people who are bottom hunting in stocks like Yes Bank are also facing anchoring bias, because they really believe that because at some point of time they have seen the stock price at some hundreds or thousands of levels, it's going to go back there. Future retail stock is a very good example where I myself was subjected to the anchoring bias 3 years back, right? So anchoring bias can happen to anybody. The best way to tackle the anchoring bias is by making sure that whatever positions you take in the stock market are taken on a very objective basis. They're taken only on the basis of objective analysis. So when you enter a position, determine what your exit strategy is going to be. And if your stop loss comes, make sure that you're exiting at the stop loss, because otherwise, if you stay anchored, you're going to keep adding your money and you're going to keep losing its value. So it's very important to make sure that you don't let that happen to yourself. The next bias that we are here to discuss is the confirmation bias. Now, the confirmation bias is a rookie mistake. How? But also, even advanced analysts sometimes can get subjected to the confirmation bias. So, what happens with the confirmation bias is that you develop a tendency, or you inherently have a tendency of seeking out the information which agrees with your line of thought, which means that if you want to go long in a stock, you will seek information which confirms that particular viewpoint of yours. So let's take an example. Suppose you want to go long in a stock XYZ. Now, you have opinion from four of your friends, okay, who are also analysts. Two of those people have a bad opinion, two of those people have a good opinion. Two of the people who have the good opinion, one of them has a good opinion for the long term but bad opinion for the short term. The other person has a vice versa. Good opinion for the short term but bad opinion for the long term. And the other two people who have bad opinions, one of them has bad opinion for the short term, other one has the bad opinion for the long term. Now, if you are somebody who's looking at XYZ stock for a short period of time, you are only going to listen to the friend who is saying good for the short term and ignore all the others. right? You will also take into consideration the opinion of the friend who has good opinion for the long term, even though his opinion may not be very relevant for your position, just to justify that what decision you're making is the correct decision. So be aware of this bias, and when someone is trying to counter an opinion, pay strong attention to them. One very good technique that is also used by technical analysts to combat the confirmation bias is inversion. So when you invert the chart, that is, you simply flip the price scale and then you do the fresh price analysis. If you're still getting a long outlook with a flip chart, it means that you're subjected to the confirmation bias. This is a technique that is used. I personally don't find this technique very good, but it's a great starting point. The third and the most common bias that we can find among retail traders is the herding bias. Okay. What happens in the herding bias? You listen to things that your colleague is doing, your friend is doing, your neighbor is doing, and you do the same thing without understanding whether it's a good idea or not. Few years ago, I think SEBI or NSE ran an advertisement about a stock that everybody was buying because Sharma ji bought. It was a very funny advertisement, but the whole message was that even if you heard somebody else buying and making a lot of money, first of all, you don't know the reason why they bought it. You don't know when they bought it. You don't know whether the amount that you're hearing that they bought is real or not, because, Chinese whisper. Factual information changes significantly when it becomes part of the grapevine. So, in herd mentality, the best way to refrain from herd mentality is doing your own analysis and relying on that. If you're not an analyst yourself, then how to avoid the herd mentality? The best way to avoid herd mentality when you yourself are not an analyst is by getting attached to a research analyst. So, how do you find a good research analyst? Go to Google, write EXP-Invest. Okay. So, EXP-Invest is my company through which I am helping retail traders make sound investment and trading decisions. So, if you go on the services page, you will see all the different ways through which I am helping you, like the Trade Together program, the Advanced Technical Analysis Trading program, the portfolio management, the long term investment plan, the consultation, the portfolio cleanup, right? Um, Taking help from SEBI registered research analysts can significantly reduce your risk in the market and help you deal with biases like the herding bias. Why? Because when you get strongly influenced by the opinion of others, then you need to have an expert who's going to tell you that no, boss, what you're thinking is not the right thing. Okay. Because this is not your own thought in the first place. And also, what you're hearing now was true, but it was true 2 months ago. And now, if the stock has gone up 15%, it may not be the best time for you to buy that stock. Okay. Now, the last bias that we are here to discuss today is the hindsight bias. So, what is the hindsight bias? It is more of a psychological phenomena in which, after an event has crossed, you think that, oh, you know what? My original thought process was actually accurate. So it basically allows you to convince yourself that after an event, you were actually correct in your prediction before it had happened. This is because humans have a tendency of uh, remembering things very partially. Okay. Um, to some extent, our memories are also figments of our imagination. Okay. And unless you don't start journaling your trades and your trade process and your research, you will always be subjected to the hindsight bias. The biggest problem of the hindsight bias is the regret that comes with it. And this regret leads to revenge trading. Revenge trading leads to losses. You never want to be subjected to that kind of processes. So when it comes to anchoring bias, confirmation bias, herding bias, and the hindsight bias, what is that one solution that can help you deal with all of these biases? The answer is the trade tracker. So what is the trade tracker? The trade tracker is an offering that is made to the members of the Trade Together program. So within the Trade Together program, there are different plans and pricing. And if you see within the different plans and pricing, we have the Esteem plan, the Elite plan, and the Exclusive plan, right? Now, the Esteem plan is the only plan which does not get the Trade Together, Trade Tracker add-on, but the Elite plan and the Exclusive plan do get the customized trade tracker as an add-on. Now, in this trade tracker, how can it help you deal with your various biases? See, when you do the analysis, either you do it yourself or you depend on a research analyst for to do it for you, right? Biases mainly kick in when you're doing your executions. But when you're doing your executions on the basis of objective analysis, and when you're capturing the data that you've executed, right? The buy date, the quantity, the cost, the sell date, and the sell price. These are the five, and of course, the name of the stock. So these are the six most important things that you need to capture. Beyond these six things, you also need to capture the stop loss level, the stop loss percentage, and remarks. Okay. Target, even if you don't capture in the sheet itself, it's fine. But these eight things are the minimum that you need to capture. Now, when you capture this information yourself, and when you come back to the information, say 3 months down the line, what happens is that your emotions associated with the trade dissipate by them. When you start analyzing the trade on the basis of your objective observations, you will see patterns emerge in your own trading. And these patterns are very different from the patterns that you will observe on the charts on the basis of you'll take your trades. The patterns that will emerge out of your execution analysis will tell you what has worked for you and what has not worked for you. Why is this important? Because until and unless we don't know what we did right, we will not know what are the good behaviors that we need to reinforce, what are the bad behaviors that we need to eliminate. Now, these behaviors are what lead to profits and losses. Now, it is not necessary that all the profits that you generated was the result of a good behavior. Sometimes, even by indulging in bad behavior, for example, you may indulge in over trading, you may indulge in not exercising your stop loss and going on accumulating the stock as it dips. Once in a while, such stock also goes up and gives you a profit. Now, if you don't know that this, whatever this profit may be, came as a result of bad behavior, you will get butchered the next time again you repeat that behavior. At the same point of time, you may take a trade on the basis of your research analyst's recommendation and trigger stop loss, incur a small loss. But until and unless you go back to do your past trade analysis, you will not know that the execution and the analysis you did was actually on point and it was mere bad luck that the stop loss got triggered. Okay. Personally, in my Trade Together subscription, it does happen that we have very good trade setups, but the stop loss wipes us out and the stock then goes up. Okay. Our attempt, our genuine attempt is always to capture the trade before it runs off beyond our entry point, right? Sometimes, even when that happens, which is bound to happen because when you go fishing, you're not able to catch every single fish. Even you're not even able to retain every single fish that comes in your net. Sometimes they get away, okay, which is fine. It's part of, it's part of the skill set. It's part of the journey. It's part of the process. So don't worry about it. What you do need to focus is that whatever you were able to capture, whatever it was that you were able to achieve, whether that was in line with how it should have been. Okay, you need to know what is working for you, what is not working for you. Now, when it comes to the stock market, right, the reason why 98% of the people fail, and yes, the number is 98%, not just 95%, as claimed by the SEBI. SEBI actually claims that 90% people lose money. But from what I have observed, I would say 98% people lose money in the market or don't make money in the market. The reason is that they don't have strong psychological control. When you start trading in the market, right, only the beginning part of that is going to be a science for you. Once you have started your journey in the market, it's predominantly going to be an art, which means the more you practice, the better you get, the better it is for you. You need to practice to identify what is working for you and deploy it further. You need to practice to identify what is not working for you and eliminate it. Sometimes we adopt bad habits by listening to good advisors also. And if you're not vigilant about how those habits are impacting your trading process, you'll not be able to improve from it. So today's session is going to be small because you might have noticed we started pretty late. The reason is that I had meetings and I have a pretty bad headache. But I decided, what the hell, let's have the session. So I hope I was able to add some value to you in today's session. If I did, please don't forget to give a thumbs up to this live session. Drop a comment if you're feeling kind. And if you're new here, then I would love to invite you to my Telegram channel, Trade with Kavita. I'm going to drop the link in the chat so you can simply click on it, my Telegram group, and connect with me. Okay. So within the Telegram group, I share my daily market outlook. I share the performance of the stock recommendations that have been given to members. Unfortunately, I do not share, actually, not unfortunately, it's just a matter of fact that I do not share any free recommendations. And there is a very strong reason for that. See, in the stock market, money is not made by knowing the name of a stock, money is made by managing positions. So if I give you a free recommendation, but I don't help you manage the position, I will not be doing you any favor. But if you join one of the Trade Together programs, the Exclusive Elite or the Esteem plan, then I not only give you trade setups to participate in, but I also tell you exactly when to exit the stock. I tell you exactly when to revise your stop loss. I tell you where you need to re enter the stock if you've exited it, and every other advice that you need. So, become a part of this systematic approach in the stock market and to justice by a portfolio. So that's all I had for today. Thank you so much for joining in. I will see you again on Wednesday in the Let's Get Technical series, where I will bring for you one stock that I'm going to take and dissect entirely to identify why I took up that opportunity. What was it technically that I saw on the charts which encouraged me to take up that position? I will also share with you the techniques that I use to revise my stop losses, and finally, how much profit we made, how did we exit, and what were the lessons that we took away to make this better. We've been doing the Let's Get Technical series for nearly 30 weeks now, and